Stanford University.
Thanks, Megan. Well, it's a beautiful day out there. I'm sorry to take you away from that. Estate planning isn't always the most pleasant topic to talk about, but it is one that faces us all, and one that is these days in a constant change of flux. And that's really what we want to talk about, is what do you do in these uncertain times as far as estate planning is concerned? Before we get started, it's always a little helpful to know kind of the makeup of the group. I see some expert estate planners here. So how many are estate planners kind of by trade or in Toby Montgomery's retirement? Okay, there's a number of you. So I get to ask you the hard questions. And the others of you, how many lawyers are there compared to, okay, and non-lawyers? Okay, about 50-50, okay. So what I'm going to have to try to do is hit a little bit of material that will maybe appeal to both groups. It's a little harder to appeal to those expert estate planners because they know what I know. Although there's a certain amount of crystal balling going on, what's going to happen in the future that we can talk about. So let me just ask another question, and that is, did anyone come with a particular topic or technique that they particularly wanted addressed? Anybody? Dick?
Now or later?
Right now. What was the topic you want? I'm not going to address them right now. I just want to see if, I just want to know for future reference in my material.
Charitable gift from 401.
Okay, the charitable rollover from an IRA. Okay, anybody else? You know, yes?
Taking advantage of the $5 million.
Okay, how do we take account of the $5 million? Take advantage of that? Okay. You don't think it's going to go on longer than that? Yeah.
A generation skipping.
Okay, generation skipping. Perfect, okay. All right. Well, that's great. So let me just start by saying that we are kind of in, and we really have been in the last several years, in kind of uncertain area. In part, it's because of kind of these three things. We have fluctuations in wealth, we have change in estate and gift tax, and we also have changes in income tax. And just to demonstrate a little bit, I mean, here's the Dow Jones over the last several years, since 2007 when it was way up here, and then it went way down basically in half. And now it's come back, and now we've taken another dip since really June. And maybe hopefully it'll stabilize, but we don't know. So people's estate fluctuate, but it's not only their estate fluctuate, it's also how to use certain techniques during those fluctuations. Family limited partnerships have discounts. How do you value them? Real estate. Maybe there are some opportunities with respect to transferring wealth that could be taken advantage of. So we're kind of living in a little bit of an uncertain area there. The estate and gift tax is also in a state of flux. So this chart, I actually have a better, this graph, I have a chart later that's maybe better. So this graph kind of shows what the estate tax exemption is and what the gift tax exemption is. Back when times were more predictable in 2000, and 2001, they passed a law in 2001 that kind of covered the next 9 years. And it had, for the first time in about 20 plus years, a difference between an estate tax exemption and a gift tax exemption. That added an element of planning to us. And then we came to this interesting time in 2009 when the exemption went up to 3.5 million. And some of you, I hope, are quick enough to realize that 2010 is actually a misprint. The exemption shows as being 0. I actually meant it to be infinity because you could have elected, if someone died in 2010, they could actually elect to have no estate tax at all in 2010. And that's what we were planning. We had to plan kind of for that possibility. We also had to plan for the possibility that there would be an estate tax because everyone thought that Congress would actually implement an estate tax and have it continue. In 2011, the law was supposed to have the exemption go back to $1 million, but on December 17 of 2010, with much advance notice of all of a few days, the Congress made the exemption go to $5 million. And it's that way now, and it's that way next year, and then it's scheduled to go back down to $1 million. The gift tax exemption also went up to $5 million, which was, I'll say, very surprising to the community of practitioners. But we have the advantage now of a $5 million exemption, both for estate and gift tax. So we're kind of in interesting territory there. We don't know what's going to happen after 2013 or 2012. And I'm going to ask you to weigh in on that in a minute. As far as gift tax rates were concerned, we kind of had some years where you could do some planning, but then in 2010, they also made a mistake here on my little graph. This should really be up here at 45%. And on page 9, there's a chart that actually is a better description of these rates. But basically, right now, we have a 35% gift tax rate and estate tax rate, but just for 2 years. Just for 2 years. And then in 2013, we are going to have either new legislation or we're going to go to a 55% estate tax and gift tax maximum bracket. And that, if you'll remember on the last slide, is coupled with a $1 million exemption unless we have legislation. So I'll say everybody anticipates Congress making some changes. I have always said there's a 10 or 20% chance that they won't get their act together, and we actually will get what is on the books now. But that means there's an 80% chance, that 90% chance that we will get something differently than what the law is on the books now. So let me talk a little bit about the considerations going forward and what might happen, and maybe get a few comments or at least a raise of hands. So our country has had an estate tax law actually 4 times in its existence. That means 3 times we had it and it was just for a limited duration, and then it went away. And then in about, to finance World War I, they implemented the estate tax, and since then it's never been repealed. It's never gone away. And prior to that, every time we had an estate tax, it was also to finance a war, but it went away. This time it stayed. And some skeptics would say, you know, once Congress passes a tax, it's pretty likely that it's going to stay with us. And then a few years later, they passed the gift tax. And the gift tax is really viewed as complementary to the estate tax. There's too many ways to avoid the estate tax if you don't have a gift tax. So we've really, since about 1916 or so, we've had an estate and gift tax. And we've changed the rates over the years. At times it was high, I think as high as 70%. And so we're kind of in this unusual period in 2001 when they got around, and there was really an effort to repeal the tax altogether. And in fact, if Congress had a 50-50 vote, if they only had to pass it with a 50% vote or 51% vote, we probably would have had a repeal of the estate tax. But there was something called the Byrd Amendment that required a 60% vote to diminish the public revenues by as much as what would happen from the estate tax. And so it didn't have 60%. They couldn't muster that many votes, so they set up this weird schedule that we had since 2001 until 2010, thinking that Congress would get their act together and do something. And yeah, they did on December 17, 2009, 14 days before the $1 million exemption would come back into effect. Well, what's going to happen in the future? It's unlikely that we'll have a repeal of the estate tax. Our economy is nowhere near where it was in 2001. On the other hand, does anybody know how many people are affected when you have a $5 million exemption of the estate tax? How many people die a year that, pardon? 0.7? And how many does that translate? Well, that's who are alive now. How about when they die? How many of those die a year? So I've heard varying estimates from 2,500 to 5,000 estates a year at $5 million. When you start talking about that few of tax returns, you start saying, is it really worth it to have a tax out of all 300 million in the United States where it only affects that? Now, there could be very large estates, and in terms of dollars, the amount of dollars they gain from the estate tax is probably on the order of 30 billion, give or take a big range from there. But that gives you, it's enough to finance the IRS. Let's put it that way. They collect enough from the IRS, from the estate tax and gift tax to finance the entire budget of the IRS. So it's probably not likely that they'll do away, although I will tell you, back in 2001, when they didn't have 60%, the scheme, the plan of those who wanted to repeal the estate tax was to gradually diminish the number of people that would be affected by it so that they then could make the argument that it's not worth having. And there are reasons that people feel the estate tax is not appropriate. It's a double tax. You've been taxed on income, you accumulate that, and then you die. There was a survey done on the estate tax, and it was one of the most, it was like out of about 12 different taxes, sales tax, gasoline tax, so on and so forth. It was ranked in the top 3 of the kind of most disliked tax, even though at the time it affected only 1% of the population. But that's how it's viewed. It's viewed as death tax. It's viewed as an unfair tax because of the double taxation. Death tax, people have to sell their farms and businesses in order to pay the tax. That's an argument. And so they don't like to do that. People have to plan a lot for it. And if you plan appropriately, you can pretty much avoid the tax. In fact, it's really a voluntary tax in one way. And that is, you can give all of your assets to charity, and there's no tax. So if you really do not want to pay taxes, there's a way out of that. That's not true with your income tax. There's limits on what you can deduct for income tax purposes, but not in the gift and estate tax area. Now, on the other side, people say that the estate tax is appropriate because the country has given us the opportunity to gain considerable wealth, and we should support that opportunity, the system that gives us that, and so those that have accumulated a lot should do that. We also are a little concerned about, back in the old days, the dynasty of the Rockefellers and the Carnegies and so on, and that we're nervous about that. It's not exactly sure that taxes completely make that go away. That is to say, if you didn't have estate taxes, that concern may be addressed by the old kind of saying that the first generation makes the money, the second generation kind of husbands it, and the third generation squanders it. There's some truth to that, and also if you draw family trees, it does get dispersed as you go down generations. So there's a lot of discussion about whether or not we'll have the estate tax. But assuming we'll have the estate tax, then there's a lot of discussion about should we have an exemption that's more on the line of 1 or 2 million, or should it be 3.5 or 5 million? Most estate planning pundits, if you want to call them that, thought it would be a $3.5 million exemption, but the Republicans were strong enough in Congress to make it a $5 million exemption. Most people thought the estate tax rate would be more in the 40 to 45% rate, but it's at 35% rate. So here's my show of hands, class participation. How many think we're going to have a $5 million exemption? And then I'm going to ask how many people think it's going to be a $3.5 million exemption? $5 million exemption going forward? $3.5 million exemption? Okay, see, 3.5 million's out. That probably means it'll be 5 million because that's what they did last time to us. The rate, it's not entirely clear. 35 or 45% is the likely rate. So it'll be interesting to see what happens with this. Well, one thing I will say, if the estate tax is ever repealed, the reason I mentioned history is most likely it will be repealed only for a period of time, and then it will come back when they want to collect revenues. One other thing I'll mention is there is an alternative to our estate tax. Any of you are familiar with the Canadian system. They basically treat death as the ultimate realization event of your assets. That is, at death, with some exemptions, they then impose a capital gain tax on all of your appreciated assets at death. And so they don't call it an estate tax, they call it a capital gain, and kind of an income tax concept, but it happens at death. And that would avoid the double taxation. And so, yeah, they have exemptions. Some exemptions, I don't know what the amounts are. So it'll be an interesting world that we see in the future. Now, let me get some basic rules before we go to techniques. We have some basic rules. The basic rule is that any gratuitous transfer is taxable, either gift tax or estate tax. And if you leave it down to a grandchild or great-grandchild, or in a trust for child that then will be distributed to grandchildren, there's a generation skipping tax. So you have estate tax, gift tax, and generation skipping tax that all come into play as you think about gratuitous transfers. There are some exemptions and deductions, and these are really the tools that estate planners use. There's the $13,000 annual gift tax exclusion or exemption. That's indexed for inflation, so one of these next years, as inflation kind of accumulates, we'll get to $14,000. It used to be $10,000. It used to be $3,000 way back when, and then was up to $10,000. And then in the last, since 2001, has been indexed for inflation. So we're at $13,000. There's a little bit of gloss to that, and that is that in addition to the $13,000 annual exclusion, which means you can give $13,000 to as many people as you want. I'm always looking for somebody to include me in that part of that $13,000. You can give that to as many people as you want. So my wife and I, we have 4 children. We could give $26,000 to each of the 4 children, and then come January, we could do the same thing again. So we could deplete our estate in nothing flat using the $13,000 annual exclusion. Now, Bill Gates would have a very hard time making much of a dent in his estate. But there is something else you can do, and that is there is an exemption for payments for medical care and for educational expenses, as long as the payments are made directly to the education provider. So grandparents who want to help their children and grandchildren. Really, they're helping the parents of the grandchildren. But if they want to pay tuition for a grandchild to go to a high school or or a college, they can pay tuition directly to the education provider as well as make a $13,000 gift to them. And if you're taking care of an older family member or any family member that you don't have a legal obligation to take care of, you can provide for paying the medical bills as long as they're paid directly to the medical provider. So that's kind of our annual exemption. We also have the applicable exclusion amount, which translates to $5 million this year and next. So you can give $5 million away during your lifetime, or you can wait till you die, as long as you die by December 31, 2012. Hopefully that doesn't happen to anybody here. You would also have $5 million. Or you could mix and match. You could use $1 million during lifetime, and then you'd have $4 million if you died before December 31, 2012. So that's our exemption, kind of lifetime exemption we talk about it. You can also leave as much money as you want to a spouse, and there's no tax. If you have a non-resident spouse, there's a certain hoops you have to go through. I mean, a non-citizen spouse, there's certain hoops you have to go through to get that exemption, and there are different ways to get that exemption, or that deduction, but it's unlimited. You can leave everything you want to your spouse, and there's no tax. Now, when your spouse dies, there will be a tax at that point unless he or she is remarried and leaves it to the new spouse. And just saying that probably makes you think that maybe you won't leave it outright to the surviving spouse, which they do have a way to leave it in trust for the surviving spouse and still take advantage of the marital deduction. And then I mentioned before, there's an unlimited charitable deduction. You can give as much as you want to charity. One of the things that we have, I've always said it's one of the only free things you get under the Internal Revenue Code. And that is when you die, it's kind of unfortunate, you only get it when you die, but when you die, your assets that have appreciated during lifetime receive a new tax basis. They're stepped up to the date of death value. Now, if they've gone down in value, they're stepped down, which we used to never worry about until living around here, 2001, and the dot-com bust, and the tech bubble. But then we've experienced again in 2008. So we can have a step down in basis. But it's a very nice thing to do. If you have taken a estate of $4 million, maybe they have a house in Palo Alto that they bought for $100,000 in probably 20 or 30 years ago, no, it was decades ago, and now it's worth $2 million, and they die, and their heirs sell it for $2 million, they'd pay no tax on that $1.9 million of gain. So it's a nice thing. The other thing, I'm sure some of you aren't from California, there are state estate taxes. Oregon, for instance, has a very high estate tax. It has no gift tax, interestingly, but it has a high estate tax. California has no estate tax and no gift tax at this time. But you need to pay attention to the state estate tax. It isn't as high as the federal tax, but it does enter in to the picture. It can enter in. So what can we do with those basic tools? The first thing we can do, I've already mentioned, is you can make annual gifts. And you can do a lot with annual gifts for most estates. Estates that are maybe just over $5 million, they can reduce to under $5 million through that $13,000 annual exclusion. You can make it to children, you can make it to grandchildren. You can't make it to your neighbor's kids and have your neighbor make it to your kids. So you can't do a reciprocal situation like that. The IRS will apply a doctrine that will treat each parent as giving it to their respective children. So there are some limitations on how creative you can be, but $13,000 is very important. There's different ways to take advantage of the $13,000. You can give it outright to someone, or you can put it into a certain type of trust for someone. There's types of trust that terminate at age 21. The more favored vehicle is something called the crummy trust. Now, some of you should laugh at that because it's not a lousy trust. It's actually after the family, Crummy, who litigated a technique that allowed it to be in a flexible type of trust that can last until age 25, 30, 35, whenever. And that is a nice vehicle. If you're going to have a stream of $13,000 gifts over a period of years, plus some appreciation, hopefully, on those invested assets, it would be nice to tie them up beyond age 21. And so the Crummy Trust is a favored vehicle. You can also combine the exemptions and the deductions. In fact, really sophisticated estate planning, and even some that's not so sophisticated, really typically combines at least two techniques or two tools. And one example, which is really basic estate planning, is combining the applicable exemption with the marital deduction. And so this is for estates of, say, over $5 million, and just for convenience sake, let's say it's a $10 million estate. Well, when the first spouse dies, the first spouse could leave everything to the second spouse, and there's no tax because of the marital deduction. They're not worried about the second spouse, so they just leave it outright, or they could put it in a what's called a qualified terminable interest property trust, but take advantage of the marital deduction. No tax, but when the survivor dies, there's a $10 million estate, and even if we have a $5 million exemption, that means there'll be tax on $5 million. And let's suppose we have a 40% tax, that's $2 million of tax. So how can we avoid that? Well, we avoid that by when the first spouse dies, instead of just giving the assets in a marital deduction format to the second spouse, the first spouse puts his or her $5 million into what we call an exemption trust, sometimes called a family trust or a bypass trust, where those assets are available for the surviving spouse and maybe the children and family at large, but is structured in a way so that when the surviving spouse dies, we have no inclusion in the surviving spouse's estate with respect to that exemption trust. And so when the surviving spouse dies, that $5 million is not included. The surviving spouse's $5 million is taxed, but it's under the $5 million exemption or equal to $5 million exemption, so there's no tax at that point. So we've effectively transferred $10 million. And actually, it could be more than that because the $5 million in the exemption trust, maybe it's grown over the 10 years. I heard just yesterday John Chauvin of the economics department say that widows generally live 10 years beyond the first death. So during those 10 years, there could be some growth, and that growth escapes taxation. So that's very nice. Question?
Have you seen planning changes to bypass trusts with the portability provisions?
Good question. So one of the things that's happened in this new law since, well, this year and next year, is they introduced a new concept, which is in order to take advantage of the $5 million exemption previously, you had to do what I said. Now you actually can leave the $5 million to the surviving spouse, and you can also kind of leave your exemption to the surviving spouse. That sounds great, but every estate planner I've talked to, and I'd be interested if there's feedback, has said because it's actually scheduled to go away in 2013, that nobody is taking advantage of that, and no planning. Anybody planning for portability of that? Yeah. So if you died without planning, you might take advantage, you definitely try to take advantage of it, but I don't think there's any planning going on with portability. Okay? Another question? Nope. Okay. So gifts during lifetime, that is, somebody mentioned about taking advantage of the $5 million exemption that we have. It's something that was unexpected. It was an unexpected gift from Congress. We really thought we would continue to have $1 million exemption no matter what, even if the estate tax went away. Everybody thought we would have a gift tax at $1 million because it really complements the income tax to some extent. But we have $5 million. So one of the things that we want to explore is how to take advantage of that $5 million exemption. And I'm going to defer that just a little bit and go through a couple of other things. But gifts during lifetime is certainly one of the things that you can do with your exemptions, and even more so now that we have the $5 million. Valuation of transferred assets is something to keep in mind. Anytime you're transferring assets, if it's cash, it's easy to value. If it's publicly traded stock, it's easy to value, or bonds. But beyond that, the rule is, what will a willing buyer pay a willing seller? And that is subject to some dispute. You have a piece of real property somewhere. It's not entirely clear what that property is worth. What would a willing buyer pay a willing seller until it's actually sold? And so estate planners kind of take advantage of that to some extent. And if you make a gift and you want a low valuation, you kind of try to get an appraisal that is on the low end of reasonableness, I'll say. And then there's also some techniques having to do with putting restrictions on assets, forming partial interests in real property, or family limited partnerships, and give away limited partnerships that have restrictions that you can discount. So just keep in mind, we're going to come back to this, willing buyer, willing seller is how assets are valued. Title to assets is very important. I just want to highlight that. Okay, the tax law changes that we've had, that we are in the middle of, that we will have, just a couple of comments about them. We have historically low rates right now, so typically people don't like to pay gift tax during lifetime, but if they thought the tax rates might go up in the future, maybe they would want to take advantage of the 35% rate. We certainly have the tremendous $5 million exemption. I've mentioned the annual exclusion already. The applicable exclusion is a historic high. Unlimited marital deduction. I'm sorry, I haven't changed my thing here. The unlimited marital deduction, charitable deduction, they stay the same. Generation skipping tax exemption is a historical high, and we're going to take advantage of that if we can. And there's something called the state death tax credit. The states that do have an estate tax, it used to be that would be a credit dollar for dollar against the estate tax. That's gone away, but is scheduled to be restored in 2013. Page 9 has our chart that I think gives you, in chart form, kind of what the graphs were supposed to do. And that, we're not going to spend time on that, we really have, but that gives you the rates and where we've been and where we're headed. So I'm going to make some just general conclusions here. Most current estate planning remains appropriate, but it's appropriate to review them. And if you make changes, it's important to review them both because of asset fluctuations and because of tax law changes. So you have to really pay attention to what's going on, more so than you used to. Also, your objectives may change as plans have that are geared to take advantage of the exemption. Just because the exemption has risen, maybe that's more money than you want to give someone, and you need to make some changes there. Tax changes will change. I think we've demonstrated that. State plans have a limited life. Review them often. Take advantage of increased tax exemption. We're going to talk about that. There's typically been a reluctance to incur gift tax with any technique. There may be some people right now that might be willing, if they were large estates and wanted to transfer a lot of money, they might feel that it's okay to incur a 35% rate. I will also say that it's actually better, and I won't go into this, but it's better to incur a gift tax than an estate tax. A gift tax gets the tax out of the estate, whereas an estate tax, you actually pay tax on the estate taxes that you're paying to government. So you're better off actually paying a gift tax. But psychologically, it's hard to do that. And also retirement plan designations. Good idea to review those. So let's get on to some techniques. What are people doing with the changes that we have and the exemption that we have? So one of the things is most estate plans, particularly when there's a husband and wife involved, involve a formula of some sort. You need to review that formula. With an exemption now of $5 million instead of $3.5 million, or in 2008, $2 million, you really need to review that exemption. So that's critical. Now, what are some techniques that are people using to take advantage of the $5 million? There are, one of the first things they think about is how do we get a low valuation? How do we do some discount planning with assets that we want to give away? If I'm able to give $5 million away, but let's simplify it. Let's suppose I want to use $1 million of my $5 million exemption. Well, I could give $1 million of cash. I could give $1 million of stock. But what would happen if I created a partnership? I put in some stock, maybe if I have a little bit of real property, maybe it's the cabin up at Tahoe, and I put that in there, and I put some cash, and I put a wrapper basically around those assets, and I give away a limited partnership interest in that partnership. What would a willing buyer pay? Let's suppose the partnership has $2 million in it of assets. Well, let me up that. Make it $3 million of assets in the limited partnership. And I'm going to sell somebody 1/3 of that. I'm going to sell a 33 1/3% interest in that limited partnership. Are they going to pay me $1 million for that limited partnership? The answer is no. They're going to be a limited partner. They have limited rights. They won't be able to sell that on the open market. They'd have to find somebody else. They're going to have to deal with the Pearson family, very difficult family to get along with. And so they're just not going to pay. And typically the discounts are on the order of 25 to 50%. You can argue what it is. So well, let's just say it's a third discount. Well, that means I can give $1.5 million of underlying assets in a partnership and take a 1/3 discount and get down to my $1 million in terms of gift tax transfer valuation. So families that want to make gifts and take advantage of the exemptions that they have will often look to a family limited partnership. Now there's a lot of T's to cross and I's to dot to make sure you do it the right way, but it is a pretty common technique these days. There's also a certain hassle with them. One of the great things about way to think about a sophisticated estate planning is a spectrum of, more tax savings means less control and more complexity. And if you don't want to save a lot of tax, more tax savings over here. If you want to pay tax, then you like simplicity and control. So if you're willing to give up control and live with complexity, you can do a lot of tax planning. That's just one way to think about where, as you think about your own self or as you think about your clients, where on that spectrum do they fall? And then it helps you, it guides you a little bit on how you structure plans. Question?
I had family limited partnerships for estate planning for a decade, and recently I've been advised by most of the estate planning attorneys to convert them to LLCs.
Oh, good question.
So, what is your point of view on that? I've actually converted them all to LLCs.
Okay. Okay. So limited liability company, LLC, versus limited partnership. A limited partnership requires a general partner. And so you have to have a general partner. Sometimes it's an individual, sometimes it's a corporation. So there's kind of that added complexity. With a limited liability company, you don't need that. There are some appraisers, however, that kind of think that on the limited partnership side, you get a little bigger discount than a limited liability company. They're taxed the same for income tax purposes, so they don't really matter there. I've really not heard people, unless you were the general partner, for instance, well, and you're the managing partner now of the LLC. So one of the downsides of a family limited partnership is to really maximize the planning and make sure that you get all the advantage is you kind of have to get out of being the managing partner or the general partner or the managing partner of an LLC. It's better to have somebody else in there besides you. The IRS takes the position you've retained too much control, and therefore it gets included in your estate. Anyway, I think estate planners have different views, and the limited partnership area is a little more built up. There's a little more law on it. Let me ask, there's some estate planners here that do a family limited partnerships. Any preference, one or the other? Not really, either way? Yeah, I think LLCs are more common now. It avoids this general partner liability situation. But I have seen appraisers who will just add on an extra 5% discount if it's a limited partnership compared to an LLC interest, which is kind of interesting. I think you could convince them that the restrictions are the same and you could get there. So anyway, discount planning to make transfers makes a lot of sense. And you can be quite aggressive. If you want to be, again, it gets to my spectrum here of how much complexity or how much fighting of the IRS. I had a case before I came to Stanford that I was involved in where we had a 70% discount. It was a timber case, partial interest case, as opposed to a family limited partnership. But that's a big discount from if the whole thing were sold. And so there's a lot of discounts. So, yeah, that's what it ended up being, was 70. I think we actually argued 77, but we caved to 70. Felt pretty good about it. But somebody wasn't. There's a lot of people who wouldn't want to take the 2 years of battling with the IRS to get that, and you have to have the right facts and so on. So there are some other techniques that you can use to make transfers that don't incur any tax. The Grantor Retained Annuity Trust is a very popular vehicle where you set up a trust, you name your children as the beneficiaries of the trust. Often it's a very short term, 2 years, and you retain an income interest in that trust. If you don't want to use up any of your exemption, you retain about a 53% or a 52.5, somewhere in there, percent return. So more than half the trust comes back to you in year 1, and the other half comes back in year 2. But if you hit a stock that is zooming upwards, there's going to be some value at the end. And that value is going to pass to your children gift tax-free under that example. Now, you can also use a GRAD and not be so aggressive in the percentage payback and use up some of your exemption. You can do the same thing with charity. You can set up what's called a charitable lead annuity trust and have the annuity, if you don't need the annuity come back to you, you can have the annuity go to charity. And Stanford's involved in those. There's actually seen my colleagues here. There's an office here called Office of Planned Giving as part of the development office. They've become experts in charitable lead annuity trust and other giving devices where charity's involved. And the reason charitable lead annuity trusts right now are so attractive, two-year GRATs also are attractive. They're kind of attractive anytime. But right now we have an historic low in the, this is going ahead a little more, but in terms of the discount rate that the IRS uses, we are in a historic low at 1.4%. And you can see actually the average is more in the 6s and 7s. But with this really low interest rate environment we are in, it really helps certain types of gifts. And one of those gifts is a GRAT that's over several years. One would be the charitable lead annuity trust. And then another technique that I have here is a sale to a defective grantor trust or a loan. So right now, you can actually loan money to someone, i.e. your children, for what's called a midterm loan duration, which is 3 to 9 years. So you can lend money to your children for 9 years at a 1.19% in the month of October, and I think it's going to be the same for November. It changes every month. I mean, that's about nothing. And if they can get any kind of investment return over those 9 years, they can pay you back and keep the differential, keep the appreciation. So right now, loans to children or other people is very favorable. Even the long-term rate, that is 10 years or more, is like 2.9%. So you might think if you're helping a child buy a house, maybe this comes into play. Or if you just want to transfer assets and you think they'll be able to, or somebody will be able to invest in a way that makes more than 1.9 on midterm or 2.9 on 1.19 or 2.9 on the long term. Sales to defective grantor trust. So another technique that people use to avoid estate tax, gift tax I should say, is they will create a trust for their children. They will retain certain powers that for income tax purposes, but not estate tax purposes, cause the parents to be taxed for income tax purposes. And maybe you put in $5 million into that trust. I mean, if you really wanted to do something fancy, you put $5 million into that trust. There's no gift tax on that. Maybe you create a limited partnership first, and so you're really putting $7.5 million of value in there, but it's valued at $5 million for transfer tax purposes. And you make the trust one of these intentionally defective grantor trusts so that any income that occurs on the asset in the trust are taxed to you as the parent, which basically enhances the transfer amount to the child. And maybe you loan, if you have enough assets, you can loan to the trust maybe 10 times the amounts that's in the trust. It's not unlimited, maybe 9 or 10 times. So that's $50 million. So there's $50 million that can be invested for children, or for that trust, which will eventually be for children or for grandchildren, or both. Now the $45 million you've loaned is going to have to be paid back. The 1.19% interest has to be paid back every year, but the $45 million principal can be paid back in year 9 as a lump sum. And all of that appreciation, hopefully, above the 1.19% that's been paid back every year, is there for the trust. So that's combining several techniques. It's combining the $5 million exemption. It's combining with the intentionally defective grantor trust so that you could buy, sell assets in that trust, and the parent pays the taxes as opposed to the trust, thereby enhancing what goes to the children. You've taken advantage of the low interest rate and been able to loan money that therefore has increased the investment possibility, and maybe the discounting. That's 4 of the kind of techniques we've talked about, and combining those to take advantage. Now, a 5th technique, all of you lawyers remember the rule against perpetuities, and lives in being plus 21 years. Love to teach my law students that, and then basically every state has a savings provision, so you really don't have to worry about it anymore. But a number of states have actually repealed the rule against perpetuities altogether. So if you want to do what I just said, put $5 million into a trust, make it a grantor, an intentionally defective grantor trust, loan it $45 million at these favorable rates, and make it a dynasty trust in Delaware or South Dakota or Alaska by naming a bank in one of those places as trustee, that trust can last for, theoretically, forever for the benefit of your descendants without ever incurring another dollar of transfer tax. So it can grow in that trust and grow in that trust, and it would not be subject to transfer tax. Now, there may be some changes in legislation that will impose a generation skipping tax somewhere along the way, but that is an exempt trust from generation skipping if you set it up now, and most likely it won't be a retroactive legislation. So that's really combining a fifth element, and I mentioned Dynasty Trust down here as something that can be used. Good question. So grats, these 2-year rolling grats have been very popular because they're so good. I mean, good in the sense of you can put money into a grat. If the asset investments don't do very well, you haven't lost anything. Everything just comes back to the grantor. But if you do well, then all the appreciation goes to the next generation. So there's only upside, there's no downside, other than having to pay the attorney a few $1,000s to set it up, which I realize for some people is a big downside. But that's there. So there's a lot of talk about doing something. Most likely, they'll probably, they're trying to put like a 10-year term on grat. People thought that was going to happen in 2010. It didn't happen. It's certainly part of the president's agenda if you look at what he proposes. I think most people think that at some point there will be some limitation on that. So that's an opportunity that may not be available year in and year out. Yeah, good question. Okay, we have 5 minutes left. Let me mention one thing on retirement plan, and then I want to just quickly mention these other slides and then take some questions if there are any. So retirement plan distributions. Anybody who has an estate with retirement plan benefits needs to really look at the beneficiary designation. It's a complicated area, lot of technical rules depending where you are. The most common thing is to leave it to your spouse as primary beneficiary and your revocable trust as your secondary beneficiary. The best planning that can be done with an IRA retirement plan is, if you have charitable intent, is to use your IRA assets to benefit charity first and use your other assets to benefit your family. And the reason for that is that IRAs and other retirement plans are subject to both income tax and estate tax at death. And it's nice to avoid that by giving it charity. You avoid 2 taxes. And so that's a nice thing to do. So if you're giving $50,000 to the YMCA or your alma mater or your local church, make that come out of your IRA, and the balance, and then the balance of the IRA or other things leave to family members. Don't put a $50,000 bequest in your will and leave your IRA to your children. Reverse that. The other thing you can do with an IRA that's pretty nifty, I'm sure all of you give, most of you would give to charity of some sort, whether it's Stanford or somewhere else. I encourage Stanford, but it doesn't have to be Stanford, is you can, for this year only, unless they extend it, you can actually make a gift out of your IRA to a charity. You can make that directly. It has to go directly to charity, and it's not includable then as income in on your Form 1040. And so if you're making annual gifts to charity or a major gift at a particular time, you might want to explore at least the possibility of using your IRA assets. You have to be over 70 to do that. And if you're over 70, you're probably taking money out as a required minimum distribution anyway. This will count towards your required minimum distribution. So that's something I wanted to mention on retirement plans. I actually, let's see. Estate planning in a low interest environment, we already talked about that. I'm not going to mention more. Historic low interest rate. My last two slides that I don't have time to go to, I was going to show how you can combine techniques. You can use a charitable remainder trust, which is a wonderful vehicle for selling appreciated assets when you want income back and you want to benefit charity eventually, and how you combine that with an irrevocable life insurance trust. Life insurance is a very interesting asset that's taxed in your estate at face value. It's not worth a lot while you're alive, but when you die, it's worth a lot, and you try to get that out of your estate. So you can combine those techniques, and it's a good example of where it's kind of a win-win-win. You win, your family cannot be hurt, and charity wins. The government kind of loses. Most people usually don't feel too bad about that, but if you want, you can make your life insurance payable to the government if you want. Okay, we've got 2 minutes, 3 minutes for questions, and I'll stay after. A question? There's got to be some question we didn't get to. Yes?
I'm not a lawyer, so I'm going to ask more of a philosophical
Yeah.
question for you, but I spent 7 years putting together the estate, paying a lot of money to your colleagues for irrevocable trusts and trust for the kids. And now that I'm looking back on it, I think maybe I'm made philosophically a mistake. Maybe I should be contributing to charity and just give the kids what they need, in which they have in their 529 plans to go through college and maybe buy a house and get a business started. Because most of the Stanford classmates that I went to school with who were trust fund babies wound up being in that third category. They squandered everything.
Yeah.
And they never developed the life skills to succeed on their own because they were given so much up front that it removed the ambition from them.
Yeah.
You have these discussions with your clients, and what's your recommendation?
No, that's a very good question, and it's really the place that you need to start. Anybody's doing their estate planning, and to revisit from time to time as family dynamics change over the years. It's certainly very different planning when your kids are toddlers than when they're in college to when they're 50. One of the saddest things around is having somebody who's 80 or 90 years doing their estate plan for their 50 or 55-year-old who has a lot of wealth, who's just been waiting for mom or dad to die so they can inherit it. And now that the exemptions are higher, there actually is more thought about how much do children need and when is the right time to get it to children. Previously, people just said, it costs too much tax-wise, so we didn't do it, and then you'd try to avoid tax as much as you could when you died. So now it's much more relevant question, what are your objectives? And estate planners should have that question with their clients. And it is appropriate to think about that. And there's a wide view, obviously. Some people who don't want to give anything more than a college education, some who want to do a lot more than that. And I'm sure if we polled the group, we'd have that wide spectrum. So that's a great question to ask. Question? Yep.
A jurisdictional question. In terms of the state taxes levied by states, if you're in a state that has an estate tax, but your assets are, let's say, property in a state that does not have estate tax, what's the jurisdiction, or even another country now?
Yeah. So when you die, basically the domicile, the residency where you die is the place to start. It will tax all of your assets except for real property that's located in another state or possibly country outside of that state. Then you would look to that state law is how that works. So, okay. One more question, then I want to, one final comment. Yes? Then arguably you're out. A lot of, yeah, you can put it in a partnership and make it into an intangible asset as opposed to a tangible asset and try to get it out that way. That can work. We're over time, so let me just conclude. I apologize. Some of you have probably heard this story before. It's my favorite attorney story, but I just have to end with it because it's so descriptive of kind of this area. And some areas are more complicated than others, for instance, retirement plan designations, but this whole uncertainty of the estate tax area. And it has to do with which of the following is the oldest profession. Is it a doctor, an engineer, or a lawyer? And the doctor, engineer, and lawyer were talking about that, and the doctor said it's clearly the medical profession because if you go back to the early part of Genesis, Eve was created from a rib of Adam. What a tremendous medical procedure that was. It had to be the medical profession. And the engineer said, well, if you go back even earlier in Genesis, it says, out of chaos created I the world, and what a great engineering feat that was. It was clearly the engineering profession. And the lawyer simply said, who created the chaos? And that is a little bit, you know, what we live in. And so I wish you luck as you attorneys who are in estate planning work with your clients and others who are doing their estate plan in your estate planning.
For more, please visit us at stanford.edu.